Hi, my name is Jahangir and you're watching News and Views. In the last couple of years, prices of oil is on a roller coaster. Crude oil is an essential form of energy to run the world. Not only cars, but factories and power stations also run on it. There are other forms of energy like solar, wind, hydro, nuclear, etc. And they all have their pros and cons. It will take decades to completely replace crude oil with any other form of energy. Oil is abundant under the surface of earth, but finding and producing it has a cost. Oil prices are very sensitive to supply and demand, and commercial companies and the countries that are exporting it want to keep the operations profitable. Too much oil and the prices fall below the cost of production, and the companies go bankrupt. That is what happened at the boom of fracking in 2014. Cost of production by fracking is about $50 to $60 per barrel. Due to overproduction in 2014, oil prices dropped from $125 a barrel to $40 a barrel. Production companies were suffering, bigger companies survived, but smaller companies folded. By end of 2019, companies stopped investing in production and the prices went up to $70 a barrel. Prices of oil slid again at the start of 2020 as consumption of oil fell due to COVID-19 lockdowns world over, touching prices at $20 a barrel. The smaller companies that survived the fracking bust closed their offices due to new price shock. Once the lockdown lifted, prices recovered fast, and by end of 2021, the prices were at $75 a barrel. The fast recovery was also due to the intervention of OPEC, Organization of Oil Exporting Companies. OPEC is an oligopoly of oil exporting countries that increases or decreases production according to the demand in the market to keep prices of crude oil at the desired level. OPEC, among others, comprises mainly of Middle Eastern countries of Saudi Arabia, Kuwait, Qatar, Iraq, Iran, UAE, which produces about 45% of crude oil but controls 60% of oil exports in the world. OPEC plus one adds Russian production of 10 million barrels per day to it. Recent Russian invasion of Ukraine severely limited the amount of crude oil that Russia could export. As there is a shortage of a couple of million barrels of oil in the market, prices are exceeding the upper bound of oil at $90 per barrel and are hovering above $100 and $120 a barrel. That roughly translates to $1.25 per liter or $4.50 per gallon at your nearest gas station. Oil producing companies and countries are reluctant to invest more as they suffered heavily in recent past. Investors are also worried that Russia may find a way to export its oil. Iran and Venezuela are not producing to their full potential and could potentially flood the market. Iran is close to an agreement that may allow it to produce a lot more. Venezuela might also agree to produce more oil and oversupply the market. These boom to burst cycles are norm of the petroleum industry and happen many times over the past couple of decades. It starts with the shortage of oil, price goes up, companies rushing to reap the benefits, and in turn oversupply the market and the prices drops again. In present circumstances, crude oil price of above $90 a barrel is unsustainable as consumption drops and other alternatives start to become cheaper. Crude price is also unsustainable below $60 a barrel as profitability suffers. In the longer run, the price that OPEC and other oil exporting countries will try to maintain is between a band of $70 and $90. For more videos like this, please subscribe to the channel. Thank you.